Hello, everyone. Good evening. Welcome to our today's class. I hope you all are having a wonderful weekend. So today we'll be talking about uh, support and resistance. We're talking about our swing as well, our major swings and our minor swing. Well, before we proceed to today's class, the last time someone asked a question about risk management. How do you manage your risk? So managing your risk, it boils down to how good you are as a trader. So if you're still a beginner, you're still learning how to trade, I would advise you first how to pay attention to getting to know what you're doing first before uh, you would talk about risk management, because there is this one thing about setting stop loss and setting it at the right place at a good invalidation point. Though I will talk about it, but if you have not learned your basic analysis, you would be having issues on where you would put your stop losses. So, and do not put your stop losses in a place that is very far from your charts. So, we'll begin. Okay. Okay. So now having to talk about our demand and okay, uh, support and resistances, our swing. When you come to your charts, basically there is a whole lot of support and resistance. Apparently, if a coin is moving, uh, because support and resistances are always a change in direction in when a coin is moving. So depending on the time frame you are on, if a coin is moving, if a coin is going, like if a coin is coming down, if there is any green candlestick here, it means there is a support at this place. If a coin is coming down at any slight green candlestick, there is a support at that particular place. But if a coin is coming down and it's all red candlestick, red candlestick, red candlestick, it means there is no support at that place. So a coin will only change direction when it meets a support or a resistance. So likewise, if a coin is going up, if there is no red candlestick, that means there is no support. But at the moment, if a coin is going up and there is a red candlestick, it means there is a resistance there. So to avoid having to deal with a whole lot of support and resistance in a chart, you are not going to mark every support and resistance in a chart. There are places that are points of interest. Your points of interest, you're always going to mark them. When you fail to mark your point of interest, you would always have issues upon issues, because not all support in a chart are actually what you pay attention to. Once you come to a chart, there are places you pay attention to. What are those places? What are the areas? What areas am I looking to buy, or what areas am I looking to sell? Those are the important areas in a chart. So when you come to a chart, when you finished marking your support and resistance, remember I always talk about not marking your support and resistance with a single line like this. Don't mark your support and resistance with a single line like this. Treat your support and resistance as a zone. So you use this rectangle, you mark your support and resistance like this, or rather you use a double line this way to indicate the body and the wick. You treat your support and resistance as a zone, not as a single line, unless there is no wick in the particular place you're trying to mark your support and resistance. So when you're drawing your zone, make sure that there is no body encroaching. The body of the candlestick is not encroaching on the side you're starting with. So now I just the first thing to do is to mark out your recent support and resistance. Your recent support and resistance. Your recent support and resistance in the sense that the latest support and resistance, which is on this chart, we have this, and place. So this is just your recent support and resistance, but this is not the actual area. First of all, this is just your recent support and resistance. Then you need to pay attention to your swing. You have to zoom out. Whenever you come to a chart, you need to zoom out to know what the coin is doing. When you want to zoom out, you squeeze your chart. When you squeeze your chart, then you look. There is what we call a swing. Is what we call a swing. We talked about it over and over the previous classes, but for the sake of people joining us today, a swing is just a movement like this. This is a swing. So a movement from up or down to up is a swing. So a movement from here to here is a swing. Here is a swing point. Here is a swing point. Swing is apparently a place that there is a change in direction in a market. So we have what we call major swing. Major swing. Then we have minor swing. Okay, how do you identify your major swing and how do you identify your minor swing? First of all, your major swing is clearly visible. It ought to be visible, clearly visible. Then minor swing is part of a major swing depending on the time frame you are on. Well, remember, when you're treating each time frame, treat it according to the time frame you are should determine what you're doing. Do not interchange time frames. When you're on a 1 hour chart, make sure you're zooming out and you're concentrated on the 1 hour chart. If you're on 4 hours chart, make sure that you're treating the swings as a 4 hours chart swing. So a major swing, it's a clear change of direction in the market. A minor swing is part of a major swing in the sense that, let's say this is a market movement. Market wants to go up like this, but it turns out market went up this way, this way, and when market wants to come down, it came down this way. Okay, so this from here to here, it's your major swing. From here to here, it's your major swings. Then we have these swings. So all these minor ones, these are your minor swings. This is the major swing, A and B. Let me know if I could label them at points. Okay. A, B, C. Okay. Then we have A. Remember, all these places are putting them in small letter. C, D. Likewise, this side we have here. Let's use G. My alphabets are not in order, so I'm just making an illustration. H, I. So now at points a distance from A to B, it's your major swing. So your major swings here is A, B. This capital A to letter B is your major swing. B to C is your major swing. So saying that your okay major swings. Okay, points A, B and points B, C. It's your major swing. Then your minor swing. Your minor swings are small letter A, B, A, D, D, C, then okay, G, H, G, I. Okay, so this from this point to this point is my major swing. Then these ones in between this major swing are your minor swing. So a coin, so you would see a major swing. You would see a major swing, and minor swings are part of a major swings. So when you come to your chart, you need to identify your major swings because these are the places you expect market to react. When you're trying to mark your support and resistances and you're using these levels, which are your minor swings, coins are actually might not respect these support and resistances. They are all support and resistances. So they are all support and resistances because your support and resistance is anywhere there is changing direction in the market. So, but which one is likely going to act? In this uh, diagram I drew here, these points, the capital letters A and B and C are expected to react than these small letters, the ones in between. So when you come to a market and you're marking out this support, this as a support, these as a support, whether to buy or to sell at these places, you're likely your analysis might be wrong. It's not like market is not going to react at these points. Don't get me wrong. Market can always react at any support or resistances, but there is an area that ought to be your area of interest. There is an area that ought to be your area of interest when it comes to a chart. Where are you looking to buy or where are you looking to sell? It's not going to be you are looking at every support in the market and at every resistance in the market. There is a place that ought to be your point of interest. Then your point of interest is what I'm trying to tell you. So your point of interest when you come to a chart should be your major swings. So we are done with our diagram. So let's go actually to a real chart. So this is your real chart. On this place now, I have my major swings. I have this place. That's my major swing. Okay. Okay. Basically, you see this place does not really have a wick, so I can use a single line to mark out this place. Then another major swing I have here. Another major swing. Oh, sorry. Let me use my area because this is I have this place. Another major swing. I have this place. So in this time frame I am on, this is the time frame I'm on. These areas are my major swings. Okay, I have a zone here that I actually do not want to mark because this zone is very, very wide. So I'm actually on just on this changing direction. Market was coming down here to this place and changed direction and started going up, and changed direction and started coming down. Right now it's making a move up again. So that is your major swing. These areas are mapped out now are your major swings. You have another one. Let's say you have another one just right at the stop here. So these areas I marked are where you expect your market to react. So when you come to this chart now, where should be your point of interest? Your point of interest should be, should market get to this zone that I marked here or here? When you're trying to trade inside this place, you're likely going to, your analysis might actually be failing you. That is one thing it does. When you're not trading a swing that is a major swing, your analysis is likely going to be failing. So again, if you have a question, please, if you're not following, you can always drop your question on the comment box, so I would attend to it. If you're not following what I'm talking about, all the stuff I'm saying, you could call my attention back, so I would actually treat it. So now the places I marked out now are your major swing on 1 hour time frame. So when you go to another time frame, you actually need to mark your swings. This 1 hour time frame might be different from what you have from your 4 hours or what you have from your 1 day. So we'll check like Bitcoin. Let's go to Bitcoin. Then this is maybe, oh, I have too much line here. Sorry. Now I have my Bitcoin. Let me change the time frame to 4 hours. This is my time frame on 4 hours of Bitcoin. Now, where are your major swings on this chart? When you zoom out, when you zoom out, when you zoom out, now where are your major swings? A major swing is where there is a change, a visible change in direction of the market. A visible change in direction of the market. Which support or which resistance should you pay attention to? When you zoom out, you could see, for you to, maybe you can easily identify your swings by using these parts, these two core parts. You just can use it where there is a visible change in direction. Notice market was going up to this place and started coming down or to this place, started going up to this place, started coming down to this place. So I have other several swings, but I would treat them as your minor swings on this 4 hours time frame. So if you want to mark your major swings on this 4 hours, you have this place. Okay, let me delete this part. I don't know if you, okay, but let me mark before I delete. So your major swings, this place. I'm not gonna mark this one, so I'm done. So I'll delete this part. So these are and resistances on this 4 hours time frame. So right now, checking out this is the current price. So market is at this current support, this area supports. Okay, market is at this current support, trying to react. It's trying to react at this current support. So because when we broke when if we break out of this zone that we are on now, markets we have another major move. Markets always makes a significant change when it breaks a major support, a major swing. That is when you have another major movement. So right now, if currently we are retesting this support that has been broken, So when this support is totally broken, we are likely to look for another major swing that we are likely going to, when we zoom out of Bitcoin, we are likely having another major swings around this place and this area. These areas are your major swings. When you look at this movement, this is just one swing moving up, 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 up until there was significant change in direction. So on these 4 hours though, so right now we are on this 4 hours support. So when we get out of this 4 hours support, or if this 4 hour support did not reclaim, if it reclaimed rather than being broken, we are likely to head up to a significant resistance again, which is around this zone. So if market moves out of this place, comes inside again, like going back, then your target should always be at a major resistance. If all uh, terms are being met at this place, if you already checked the support and resistance and it's been met, that means your next area of interest should be on the next major resistance. If coin is moving, if Bitcoin is moving after, if it reclaimed this place, I've not done any analysis showing that it's reclaimed or not, but if it reclaimed this place, that means trying to short Bitcoin in these zones with this 4 hours time frame is just like you're wasting your time, because these areas, there are support and resistances. When you're looking at it, there are support and resistances here, there are support and resistances here, there are support and resistances as we're moving. But trying to short Bitcoin at these support and resistances will always give you a false signal. You might end up, oh, why am I losing? Why am I losing? You're losing because you're always shorting the market at the wrong place or buying the market at the wrong place. If you're already, if you're going to be having patience for a coin to get to a major support or a major uh, resistance, you're likely going to be profitable in the market. But if you're always chasing the market, trying to trade against the direction of the market, you'll find yourself losing. So whenever you find yourself in a chart, go to a major support or a major resistance, which is your major swing or your major swing, either at the support or the resistance. Then the swings, these minor swings, it's just a pathway to it's a pathway to, if a coin is moving, and likely they might not react, they might react, they might not react. So if a coin is moving up, let's say our coin is moving up, it might skip all this minor swing, it might react at one, just a little, continue, react another. Like, you won't be getting a full action of a support or a resistance from minor swings, because they would always be giving you false signal. It looks like the market wants to change direction and they will continue going up, up, up. That means when you short, the market continue going up. But when you short at a major resistance, a major swing, you are likely to see a significant change in market direction, all the way down to another major support. So that is the difference. Shorting at a minor swing and a major swing. The major swing is always profitable. And as a trader, there is no need of chasing markets on the minor swings. Always focus on the major swings. So how do you use your minor swings? That is another stuff I want to talk about. How do you use your minor swing? When the coin is moving, just like this movement, a coin is moving to its direction with minor swings. If it's coming down to support, it's coming down to support with minor swings. Just like this coin is coming down to support, the minor swings are all this you're seeing, all this change in direction you're seeing, or this, or this. These are the minor swings. These are the minor swings. These are the minor swings. All these are the minor swings. They are whereby the uh coin is using to come down. Whichever all these swings you're seeing here are the minor swings. So if a coin is coming down, it's using these minor swings to come down to the actual support it's heading to. So how do you use your minor swings? if a coin is coming down to a major support or a major resistance, for you to be able to trade your major support or a major resistance, you always need the help of a minor swing. The help of a minor swing in the sense that if I have this zone as my major support and a coin is coming down like this, coming down this way, coming down this way, coming down this way, coming down this way, now coming down to my support, and it bounces as my support. You've already checked the candlesticks, and the candlestick is actually telling you, oh, here is the bullish. Then the aid of a minor swing is to help you know if a major support will hold. First, a minor swing will start changing for you to know that a major support will hold. In the sense that this is my last low, this is my last low, this is my last support of this minor swing, this is my last support of this minor swing, this is my last support, this is the next support. Now, if you want to know if this bigger support, let me change the color of this bigger support, something orange. Okay, if you want to know if this bigger support will change, your minor support will start changing after it gets to this major support, in the sense that when a coin gets to this place, you expect a bounce to reclaim this support, this last support of this your minor swing. To if you get something like this, a bounce at a major support, close to it is changing already. That means if and retest is very important. If your market does not retest, do not bother taking your trade. It's always very good to take a trade that is very, very assured than having a trade without retest. So this telling you that this minor swing support is holding. That means this bigger support is likely to hold. But a coin is coming down and bounce is coming down like this. Oh, hold on. Let me just delete this. Okay, so this is your last support. If your coin is coming down and this is your major support, and instead of reclaiming this last minor swing support, it rejects the minor swing support and starts doing something like this again, it means that this major support is not going to hold. Okay, I'll talk about risk management. So, well, let me be done with my class now. So, okay, now if your minor swing did not hold, this major support is likely not going to hold as well. So, first you have to check if your minor swing support is holding, in the sense that the last support of this minor swing, is going to hold. This market is going to come above it. So don't always take your trade at this major support. Wait for your minor swing to first change and your major support to be holding as well before you confirm that this bigger support will hold. It's always very safe, in the sense that let's go back to Ethereum. Okay, on 1 hour time frame. Sorry, my 1 hour time frame. Okay, let me just reset my chart. Okay, this is what I'm talking about. Okay, look, when this coin was coming down to this support, here, look at this support. It was coming down to this support, and you can see the minor swings. They are very tiny because of its movement. They are very tiny in the sense that you can see a small change in direction here, here, here. These are your minor swings. If it's not clear, you can go down to a lower time frame. Let's go back. Okay, this 2 hours. Let me go to 1 hour. Okay, now these are your minor swing. Now these are your minor swing. This is your minor swing. This is your minor swing. This is your minor swing. Coming down to this support. This is the support we are talking about. Coming down to this support. Now, this minor swing bouncing at this support. This supposed to hold. This support supposed to change in the sense that you mark out this minus, the last minor swing, which is this one. So this is your last minor swing. So this minor swing needs to reclaim, in the sense that there should be a breakout which happened at this place, and after the breakout you ought to see a retest. Although in this case there was no retest here, you're supposed to see a retest bouncing at this support that was broken, and we continue going. Assuming we got a retest here bouncing at this place, this market would have moved to this place, but we didn't get a retest at this zone, and apparently the market will surely come back to retest this zone. So this is a sign that this major support will hold if this minor support holds as well. So you're making sure that your major support is not broken. Even if it gets broken, you make sure that it reclaims as well, and this last minor support will also reclaim. If this minor support did not like this place, at this place, after it bounced at this support here, it was broken and it rejects, it made another minor support. This is a minor swing again. Sorry, this is a minor swing, this is a minor swing again, like this place. Look what happened here. This is your minor swing. So when this bounced at this place, it went back to test this minor swing, and this one did not hold. It came back again to this place, creating another minor swing. So this other minor swing is what hold. Look, it holding is dropping a bullish candlestick. Dropping a bullish candlestick at this zone. So this minor support is holding, and you look out for your for this area. Look at this area. This is your major support. Your major support needs to reclaim, because this major support is broken at this place. Your major support needs to reclaim and a retest as well, in the sense that this market ought to have, after this major support was minus support was holding, it ought to reclaim and retest this zone, and which it didn't retest this zone before going up. So, but for very safe, for you to be on a safer side, always wait for a minor support to hold, either before bouncing at this support or after bouncing at it, and a major support to also reclaim and retest for you to enter the market. So if there is any question, you should ask if there is any question. So I would probably talk about it before I would go to risk management. If there is any confusion, any question, you drop it before I move on to the next section. So let me say that our market started going up again. Let's say our market started going up again. Let me delete this. If our market starts going up again, let's say this market start going up with a minor swing, a minor swing, a minor swing, a minor swing, getting to this major resistance. A bounce at this major resistance is not enough for you to take the trade. You need to wait for this minor resistance to reject as well. If you don't have any minor resistance rejecting, you shouldn't take the trade. Like what I mean is this resistance here, coin breaking through this again and bouncing at this resistance and rejecting. This should be a safer entry. This should be a safer entry rather than jumping to take this trade at this place without the minor swing changing. So you see that the minor swing and the major swing, they work hand in hand. This cannot do without this. This cannot do without this. Your major swing is where the major reaction is occurring. Then your minor swing, it's if when it starts changing, that means the major swing will change as well. So those are the difference. So if you have any question, you should do by just typing on the comment box. If you don't understand the major swing and the minor swing, but just bear it in mind that when you want to mark your area of interest in a chart, it should be your major swing, not these minor swings for you to take a buy or a sell. So your risk management, when you're talking about risk management, the few stuffs I'll talk about risk management, because I don't know how you trade. I don't know your pattern of trading. But when you want to make a trade, one, make sure that the strategy you're using, the market meets the whole strategy you're using. When you want to trade, make sure the market meets the whole strategy. If there is any part that was not met, kindly do not take that trade. Like if a coin did not retest well, or the all the condition that needs to be met with your own strategy, it's not being met, is number one risk management. Do not take the trade. One, if a trade is giving you some amount of profit, try to adjust your stop loss to your entry. Even if the coin comes back to your entry and kicks you out, it's always safer. If you want to enter the coin again, you have to make a new analysis. When you are in a trade, in a losing trade, and you're making analysis, it causes you to be biased. So always set your stop loss and don't make mistake of when a coin is close to your stop loss, you start adjusting your stop loss. Do not adjust your stop loss. Never. When a trade hits your stop loss, you can either try not to trade, like you exit the market completely and look for another opportunity, or you have to look for to re-enter the market. And when you're re-entering the market, make sure you've made a new analysis. So you don't just make mistake when the coin is, maybe you put your stop loss at this place and coin, maybe your stop loss is here and your coin is moving close to it, and you remove this stop loss and take it up here. When the coin is coming to this place, you remove the stop loss and take it up here. It means that you don't even know what you're doing. There should be an area of invalidation in all your analysis. If I take this trade at this support, if I take this trade at this support, if this trade go beyond this support, so your stop loss should be some distance away from this support, not at just come make drop some week. Sometimes can just drop some week. For the week not to touch you, sometimes just take your stop loss a bit from this area of your support that you took the trade. If you took the trade as this resistance, take your stop loss somewhere away. Don't place it exact place. Then when you're already running in profit, bring your stop loss back to your entry, so that if the market didn't go as you planned, it will kick you off. But never make mistake of taking a trade without stop loss. That should never be done. Don't take a trade that there is no stop loss. And don't put your stop loss so far. Let's say you're taking a trade. Oh, you're taking a trade from here and your target is here and your stop loss is here. don't take that trade. This is rubbish. Because if this goes wrong and your stop loss is here, it kicks you out and it fucks your account up. Let's say you're trading with $100, you're trading with $100, and you took a trade of $100 from this place, 100 USD from this place. Then your stop loss should be at least a place, maybe here. You should be getting like a loss of you should be getting like maybe a loss of 10 to $15. It depends on what, but don't go beyond 50% of what your maybe what's your expected. Maybe from here your profit should be like any profit at all, but your stop loss should be according to your account what you can afford to lose. But don't risk 50% of what you have in your account. You should always make it like you would have some left in your account. If your account is $100, your stop loss should be like $5, $8, $7. Highest should be like $15, $20 highest. So that when a market kicks you out, it doesn't fuck your account up. If your account is like $100 and your stop loss is like $80 or $50, it's rubbish. Because when it kicks you out, you might not enter, or if you enter another trade, you make a stop loss that is very high again, 2 to 3 trades, your account have blown. When you take your stop loss a bit by bit, you are going to recover than trying to make your stop loss. Don't set your stop loss so far. If you're taking a trade that you don't know where your stop loss is, do not take that trade. Your stop loss should always be very close. And don't set your stop loss depending on your account. If there is a trade you saw and the stop loss is very far, depending on your account, that when you take that stop loss is like half of your money in your account, do not take that trade. Do not take that trade. Don't make mistake of taking the trade so that you don't blow your account. Market is all about getting the right analysis and risk management as well. Risk management will always keep you intact so that you don't make mistake of blowing your account, and you will not be affected psychologically. Because if you're being affected psychologically, you are bound to start messing up your analysis. You might need months for you to recover from it. So don't make mistake of using a very high stop loss. You take your stop loss very close, and when a market kicks you out, try to come out. Don't revenge trade. Revenge trade is like, oh, I'm out of this market, you jump in again. I'm out of this market, you jump in again. Or this market is my stop loss is here, and market gets close to your stop loss, you shift it. It gets close again, you shift it. This will fuck your account up. Or maybe it gets to your stop loss, you remove your stop loss, wanting to close that market by yourself. This will fuck you up because your emotions will overrule you always, that you might never close this market until your account is liquidated. So whenever you encounter if you want to win your emotion, because you always need to win your emotion instead of the emotion winning you, set your stop loss. Worst to worst, leave the market when you take a trade. If you cannot control you trying to adjust this stop loss, leave the market. When you take a trade, if you can be able to hold yourself, you leave the market completely. If you do not want to be, if the market hits your stop loss, fine, look for another opportunity. There will always be an opportunity for you to recover. Maybe your account is like $100. You took first trade, second trade, third trade, you lost 3 of them. If you are losing like $30 and you're having $70, you might make a good trade and you win $15. It's a bonus. You might make another trade and you win another $10. It's a good trade. Now you are recovering your capital back. But let's say your stop loss is like $50 or $80. You made the first trade and you lost $50. Then you made a good trade. You won $10. Then you made another trade and your stop loss is like half again. You lost like $40. You'll be having like maybe extra $20 or $10 to play with, and which is not enough for you. And you start revenge trading, trying to win back your money, this and that, and you end up fucking yourself up, which is not always good. So I will always advise you, any market that does not have stop loss, you shouldn't trade any market that does not have stop loss at all. So I don't know if I cleared you. Then if there is any question so far, you ask based on what we talked about, our major swing and our minor swing. If there is none, we'll be ending our class for today. So far, I've not gotten any question. So, but I believe if you do not understand anything, you can always rewatch the video. And if there is a question, drop comments on this particular video. I would always talk about it on the next class. So I would have to treat your particular question. So in case you missed asking question on this class, then you can wait for our next class. So you could come out, or when you drop your comments on this bus, I would get a notification now, and I will have to treat your question on our next class. So if that's all, that's the end of today's class. So you all have a wonderful weekend and have a wonderful night as well. Gracias. Bye.